So good afternoon, everyone. We are very happy to be with you this afternoon. We hope you've been enjoying the conference so far, and Grace and I have been enjoying the sun. So quite a nice start. But today, people, is actually a very special day because you get to meet the A team of MME. So MME is a Swiss-based law firm, leading a law firm in the crypto industry. And the A team that you have today is composed of Grace and Anne-Lorinne, both EU qualified lawyer, Belgium, France, and both being able to advise on their EU and Swiss law. And I think we have to be honest with them and Grace right now. I'm very sorry if some of you actually came just to see us cry. It's not going to happen on stage today, and really sorry for the disappointment. But actually, the title that we came up with is because it has a sort of documentary sense of what has happened over the last 2 years. Because when advising clients on this topic, we always run into the same big paradox, which is stablecoin is the most widely used application on the blockchain. But on the other hand, when you actually want to start issuing one, offering one, having any service related to it at a global stage, then you run into a very fragmental regulatory landscape, which can bring some tears for the lawyers or some headaches for the client. So the goal actually of today's talk is for you to leave the room without crying, without any headaches, and to have a very high-level understanding on how it works for Swiss, EU, US, and to also start identifying with you some solutions so that we can bridge actually solution between jurisdiction. So buckle up, guys. We're going to start. And Grace, it's your turn.
So, as Anne-Lorinne mentioned, we will explain why lawyers hate you sometimes when you come up with a new stablecoin project and it's of being super enthusiastic and our faces less. So first of all, it's because we have one concept, stablecoins. It's one of the major narratives. Everyone loves stablecoins nowadays, but there are many nuances. So first of all, stablecoin layers. It starts in a pretty easy, obvious manner. We all think that, stablecoins is actually just a token issued on a blockchain that has a value designed to maintain a peg. That's so obvious, so easy, it's smooth. Against another asset thanks to a stabilization mechanism. What is complicated about it? Nothing so far. We just need an issuer, an entity, or maybe we can have like a automated, decentralized issuance, a value reference. It can be anything, right? $1, euros, another asset like gold. Then we have a stabilization mechanism. Just however you want to make the peg, it just works. And the redemption. How can people redeem the underlying? Seems quite straightforward. But then you look at what's actually happening. And you realize that, this comes from Kraken lately, 9 out of 10 the largest stablecoins are US pegged. Why would we have 9 times the same thing? Like, why would we have 9 stablecoins against the same peg? Well, the answer is because they're not all alike. So with this one definition, we end up with a lot of different implementations. How come? Because you can have centralized, decentralized issuers, you can have different types of reserves, like how is it structured? Do we have like some algorithmic things, or do we have an actual reserve? You have different redemption mechanisms, and sometimes you try to implement yield or not, but we'll dive a bit more into that afterwards. So basically this is already solid grounds to have a headache, because someone comes with this idea, I have another stablecoin, and then, okay, but what exactly are you doing with your stablecoin? So lawyers, this is when the tears come out, and this is what we experienced so far. Next slide.
And then you have, on top of what the clients want to do, you have also then the cultural specificities. So, because what is actually interesting is that all jurisdictions don't put the same emphasis on the same layer actually of the one we just presented you. So if we start actually with Switzerland, where our heart is, the main, what is decisive for the definition of stablecoin under Swiss law is the stabilization mechanism in the redemption. Because under Swiss law, a stablecoin is considered a payment token, but on top, if you have a one-to-one redemption claim and you have this reserve mechanism in fiat, then you have actually an activity that starts to look little bit like a deposit, and so you fall under banking regulation. Then if we look at the EU, which is actually a complete contrast, in the EU, what is actually the most important is the value reference, because funny enough, well, I mean, funny for lawyers, the regulation doesn't talk about stablecoin at all. Like maybe a little bit in the recital, but very quickly and in a very Cartesian manner, the regulation has distinguished between e-money token and asset reference token. And what is the difference between these two is actually what you are going to peg it to. So are you going to peg it to one fiat currency, then like USDC, USDT, then you fall into the e-money token? Are you going to referencing to something else, gold, multiple commodities, a basket of fiat currency, then you fall into asset reference token. And in the US, my understanding is that they start actually from the use case, like because the US regulation only talks about payment stablecoin, whereas the EU, for example, by e-money token, it's more about, okay, I have a means of payment, but my asset reference token could also be used as a store of value or means to invest. The US focalize on the redemption and the fact that you have it to be used as a means of payment, and then makes the whole regulation very heavy on the redemption claim and on the reserve mechanism. So actually, exactly like Anne-Grace explained, we start from a very easy definition. Everybody seems to understand the same thing, but in the end, we don't exactly talk about the same thing, so it starts to look like a zoo.
And for us as a challenge, it can be quite entertaining, let's say it that way, once the tears are gone away. But we end up with debatable cases, and Anne-Lorinne will explain them more once we dive into the different jurisdictions. But I mean, there's no universal stablecoin in the end, because people show up saying, hey, I'm issuing a stablecoin. Well, it could be that in some jurisdictions this is not actually a stablecoin, it's something else. And there's this discrepancy between what the market thinks is a stablecoin and what law thinks. Sometimes they say it's not a stablecoin where it actually is, plus it's not necessarily in all jurisdictions. You could also have some misnamed derivatives where your stablecoin is actually a derivative. You can also have some stablecoins against their will. You don't really intend to issue a stablecoin, but because of the design, well, some regulators will actually consider that it is a stablecoin. So there's this fun area where we start to spend hours just thinking about everything, and that's where the fun begins.
I agree. So you also wanted to address the risk before.
Exactly.
Deep dive on that and avoid the headaches.
So just to reset this background, let's say that way, all of this design carry different risks. And there's this hype, because it all starts with the hype. What do we want to offer for stablecoins? And there was a lot of promises. I mean, they were promoted because we'll have censorship resistance, like everything in crypto resists censorship. So no state or financial institution preventing you from using your funds. That's the great part. Transparency. Everything is on chain. You can always locate and see your funds, what happens to them. Financial inclusion was also one of the promises. We hear a bit less about it now, but still, anyone can hold stable coins, make payments, even in jurisdictions where financial systems are a bit more complicated, or let's say non-existent or slightly corrupted. It all works. And programmable money. Also, this we hear a bit less now. It was mostly for DeFi. We can have automated loans, things happening in a very smooth manner where we don't have intermediaries involved. Well, none of this is realistic when we look at the state of things now. Censorship resistance is tackled with centralized issuers mostly. When we look at the list from a few slides before, most of the stablecoins are centrally issued with sometimes, and even most of the time, freeze and burn functions, which sometimes stem from regulatory constraints, sometimes just because of obvious needs, operational needs. We have off-chain reserves depending on the structure, or at least omnibus accounts related. We don't hold our stablecoins necessarily non-custodially. It happens on Saxes and so on. Financial inclusion, well, in the end, we have a scarce network of merchants. Increasingly, we have access to payments for stablecoins, but it's going to be through financial intermediaries, payment cards, things that have KYCs, and reintroduce in the end this aspect of potential exclusion. It's a bit too fast. And we have mostly an extensive trading use. When we look at it, stablecoins are not used for payments of my groceries or my flight ticket. It's going to be mostly trading, for trading pairs, pools, and so on, liquidity. And same for programmable money. Well, we don't really have that many real-world use cases with DeFi. It's going to be mostly loans for trading, not loans to buy my next house. So the hype reality, well, now we go to the next. From this becomes the risk and the regulations that had to step in to kind of tackle this issue of we had one promise, an implementation that's not fully perfect. Okay, what do we do about it? So we have counterparty risk. As soon as we have a centralized issuer, what do we do about it? Also identifying, is there a centralized issuer? Because we also know the story of the claim, this is decentralized. Yes, someone is holding all of the admin keys. Not really. Reserve quality risk. Not all reserves, not all pegs are the same depending on how it's structured, and we've seen it a lot of times. There are some possible failures, more or less important, but they are failures. Smart contract risk. It's on-chain. No technology is perfect. What happens? Depending on how things are structured, who is responsible for a DPEG? And liquidity risk as well. Not all stablecoins are alike. You may have a great stablecoin, but if you cannot swap it, cannot use it, there may be an issue. So these risks materialize in several cases, and this is what ended up leading this wave of regulation for stablecoins, because we all need them, but we want to make sure that they don't disappoint us.
So now it's the tricky part, because we don't want to actually bring any headaches for those who are not lawyers in the room. So we will start very high level and just try to give really like a very clear idea of how it is regulated under the different jurisdictions. If we start with Europe, so as you all may know, so the relevant legislation is MiCA, so MiCA, Market in Crypto Asset Regulation. And as we just explained, so we have two types of crypto assets, so EMT and RT. The main difference actually between these two in terms of regulatory requirements is that for the EMT, it's only credit institution or electronic money institution who can actually issue them. And you need a white paper, but not to be approved, only notify. So meaning that it's like a stamp requirement. It's not really like the regulator is not going to go in depth in your white paper to really know what is promising. On the other hand, asset reference token are way more stringent in a way, because it's for people basically who start from nothing. So either you can be a credit institution and offer it, but you could also be someone who wants to obtain the authorization to be able to issue it. And in that case, like, you have to go through a very heavy application, which looks a bit like a CASP application in some manner. And your white paper needs to be approved by the regulator. So that's already like quite a burdensome aspect. And as no surprise, if you have a look at ESMA database today, there are no asset reference token in Europe.
How surprising.
How surprising. But as you can see from the definition, because asset reference token is defined as a type of crypto asset that, it's horrible, the definition. So basically, like, it's one crypto asset that is meant to be pegged to one or different asset, not just one fiat currency. And you can see that because of this reference mechanism that it is defined in the definition, some lawyers actually and some regulators have used this category to be able to attract, let's say, anything, be it a wrap token, liquid staking token, and as we believe this should not be the case. I mean, it depends, of course, on case-to-case basis, but this RT was actually used as, let's say, a fallout category, and was not meant to attract anything or even become like a way to tokenize, I don't know, ownership or this kind of thing. And I think some people who really love to deep dive into definition see that as an opportunity to get a license and maybe some fees, I don't know. But that should not be the case according to our reading. So that's for the European Union. Now, if we look at Switzerland, dear Switzerland. So Switzerland, so it's actually, stablecoin have it's two things. Like, it's on the one hand, as I explained earlier, a payment, so a means of payment. And on the other hand, it's also a deposit because you have if you have a fixed redemption right. And if you combine these two, then kicks in actually banking regulation and AML regulation. If you have the AML aspect, it will mean that you have what we call in Switzerland the SRO membership, which are self-affiliated organization, something very Swiss, that you only take, usually it only takes 3 months to get, so it's very different to, you know, an RT, which will take, I think, at least a year to get. And on the other hand, you have the banking license because of this deposit activity, but you can actually obtain not to have a banking license to be able to issue it out of Switzerland, thanks to, for example, if you have a bank guarantee. If you have a bank guarantee. And And in that case, you just need actually to, we just need this bank guarantee, but you still need, and that's the problem in Switzerland, you need to identify since July 24 all your stablecoin holder during the whole time of the process, which is economically and technically almost impossible. So that's why actually we have a future regime that is coming in and is under consultation, where actually the stablecoin issuer would have a new license, which would be payment instrument institution. Since we're only 5 minutes left, the US, it's very easy.
So that's how they sell it, right?
It's very easy, you're right. So Genius Act, payment, you have a federal and state track, figure it out. So
I mean, it's not applicable yet anyway. So.
Exactly. So
now,
you have time to cry for that.
Exactly. So why do we cry now? Well, first of all, because we don't have any clarity regarding what is centralized, decentralized. So that's the first point. We may have someone who comes to their beloved lawyer saying, we have a decentralized, autonomous, algorithmically stabilized stablecoin. And it turns out that actually they would be regulated because they're not fully decentralized under very vague criteria depending on the jurisdiction. And then all of these regimes in the end require some sort of authorization, whether it's as a specific institution, whether it's just being a financial intermediary or like being defined as an issuer. So conclusion, no universal authorization yet. You can't have this promise of a universal stablecoin. It's going to be different depending on the jurisdiction. There's no perfect overlap in obligations. Like the obligations are not the same in every jurisdiction. It's not because you managed to obtain a license in one that you can just transpose everything you've done to another one and obtain it too. You may have to do adjustments, but if you have global coverage, that's a lot of paperwork. Lawyers will love you, but your teams will love you less. Now, one token, that's too fast. One token is also countless processes to ensure, so this is what I mentioned just before, unless you aim at being part of the alternative economy, but then it means no listings, no integrations with partners. Not many stablecoins are aiming at that. And it also makes marketing difficult because of all the promises of stablecoins, you want to promote your stablecoin in a uniform manner, not having different disclaimers and things depending on the jurisdiction. So the whole process becomes an administrative mess at the end that you cannot deal with in a smooth manner without the lawyers. And also all these regimes in the end render the advantages quite impossible actually, because censorship is reinstated by design. You have AML processes kicking in, the need to freeze sometimes assets and so on. You have trust-based transparency being institutionalized. We're not putting everything on chain. We have reserves that are being audited, someone who ensures it, but you need to trust the audits, you need to trust that regulations are being complied with. And also like it becomes as inclusive as any other currency that has AML checks and so on in place. So in the end, all of this, I mean, it sounds a bit negative as presented, but it's quite positive because it allows stablecoins to be smoothly integrated, including with existing financial institutions. We may have more payment solutions. I mean, we have credit and debit cards kicking in. We have like Stripe and so on. So stablecoins will join the economy and be more broadly adopted. But still, we are deviating from the original promise and still creating a headache, which is a bit more what we are used to in the traditional financial system. So issuance of a stablecoin, just like a brief comparison, I mean, just between having a stablecoin and being an AMT in the European Union and a payment token in Switzerland, a lot of things are different. And I will just go briefly through it, but just token design constraints, you have so many constraints in terms of like no interest, how is the claim, what is the adequate stabilization mechanism. In Switzerland, if you have banking regulations kicking in, no interest, no yield, but for the rest, you don't have any requirements in terms of how is the stabilization mechanism supposed to be. Same in terms of the entity. Reserve requirements, capital requirements, all of this does not apply with the SRO membership. So there's quite a lot of, let's say, overlaps that are not existent. If you issue it from Switzerland and then you need to extend to the EU, you'll be like, damn, I really need to improve my setup. Then next. Now, offering stablecoin services. Just the list is pretty extensive. As soon as you touch stablecoins, you end up having potentially a regulated activity. And I mean, in the EU, it's quite obvious because we just have the whole list of crypto asset services. It applies not only to stablecoins, just to any token being a crypto asset, according to Mika. In Switzerland, maybe it's a bit more manageable. In the United States, we will see how it's implemented and defined in the end. But in a nutshell, if we need to keep something in mind, it's like, why would we cry? Well, again, because all the services, we need to know whether decentralized or centralized, because based on that, they either get the adequate authorizations or not. And if you operate on a decentralized basis and then someone tells you, well, actually, you're a CASP, and on top of that, you handle stablecoins, we have a pretty big issue. And you have like this contagion effect. We started by regulating crypto assets in the EU, or like stablecoins, let's say in general, in other jurisdictions. That's the backbone of a lot of services. Trading, pools having one of the assets being a stablecoin. Well, because of that, because you touch stablecoins, you become potentially a regulated operator as well. And just launching quickly, bootstrapping an MVP to test whether there's traction becomes impossible. You have the cost of compliance, and on top of that, you need to take into account the licensing process. And that's not always how market operators want to proceed. You get funding, you want to launch as fast as possible. No, you need to get the adequate authorization first. So as well, like financial inclusion, because of all of this, becomes contaminated with AML and so on, which has its benefits. But once again, we're drifting apart from the initial promise.
So just as we get the sign, in a nutshell, for like be able like to issue a stablecoin globally, just having a very quick look at the solution. If you actually want to use reverse solicitation or mutual recognition, basically it's a no-go, because like except for Switzerland, where reverse solicitation can be an issue, like in the US or in the EU, you need to have either like an authorization there, or you need to have substance there, you need to have something, like you cannot touch the market like that. Mutual recognition, I would say yes, but because the problem is that yes, in the regulation we do have some provision always to say, okay, we are going to work with other jurisdictions to see if we can have an equivalent regime, but that's rarely the case. Like, I mean, it hasn't really been studied yet. And then the other two options that could exist is, of course, you buy someone who already has a license, but of course there is always the risk when you buy someone, you have to check the reputation, what has happened so far, operational risk, compliance risk, and all that. And for the partnership, it would be to find someone who is okay to actually welcome your product in a white label manner. So that will be it for today. Thank you so much for your attention.
So if you want lawyers who don't cry anymore because we've been through it.
Because we're bulletproof now. Thank you so much for your attention, and enjoy the conference.